Hello, hello, everybody, my spirit animals. This is your boy, Sean McLaughlin at Options Sean on the old Twitter X. Today is Wednesday, January 28th, 2026. I'm still not used to saying 2026. Hope you're doing well. This is the What Are My Options show. It's a show. We try to share a little bit of educational content, and then we try to do a little, open door office hour situation. You can ask me any questions you have related to options trading, about strategies, when to use them, when not to use them, how to take profits, how to manage risk, anything related to options trading. Or if you have a trade that you're considering putting on and you want me to look at it, or a trade that you have on and you want to know what to do next, open door, folks. Come on in. But before we get into the open questions, and by the way, you can put those questions into the YouTube chat. I will see them. I got them right here, my side screen here, and I will answer them if I can, as best I can, as urgently as I can. But before we do that, let's just talk real quick. Today's a Fed day, right? So in 2 hours from now, at 2 o'clock Eastern, the Federal Reserve is going to announce whatever they announce on earnings, good, bad, ugly, indifferent. Who cares? I don't know. But I don't know if the market's expecting any big moves out of this, but we've seen big moves come out of Fed talks and announcements before in the past. And so, with that in mind, I tend to not like to do a whole lot leading up to the announcement. I like to let things shake out a little bit. I'm not sure if I'm going to put any more trades on the rest of today. Um, it's good to be, I got a lot of stuff on, so I got plenty of stuff to watch if markets get wonky after the Fed. But probably not gonna put anything new on for the rest of the day. Just see what shakes out. Um, I want to address a question or a situation that's happening right now. In the All Star Options chat room, one of our traders in there was talking about a vertical spread that he's got on in silver. Now, this is not germane to silver. It could be in any instrument, but silver is a hot topic these days. So let's bring up a silver chart here. Gene, if you could bring up my chart there. I've got the SLV chart, and holy moly, have we had a parabolic rise in silver. There's no other way to describe what's happened here. I mean, just as recently as end of August, Labor Day, the stock was trading at, or the silver ETF was trading at 35 bucks a share. It has gone on to triple in value since Labor Day. Holy cow, we haven't seen a move like that in silver in a long, long time. It's happened before. It's definitely happened before, but it's been a while. Quite a move. And somebody in my community has a trade on here, and he's wondering why the hell isn't the spread worth its full value by now? Both options are in the money. So let's break it down. Let's talk about what he's talking about. He has a vertical spread on. And I believe I have the trade right here. I might not have the details exactly right as it pertains to his particular trade, but this is relevant to anybody. All right. I believe he's got on a June 80 100 bull call spread in silver. So that means he's long the 80 calls and short the 100 calls. I've put together a P&L graph of what this looks like. Okay, so this is a P&L graph for those of you who have not seen something like this before. The blue line shows you what your P&L would be across a range of prices, a range of prices for SLV. Those are here along the x-axis. What your P&L would be across a range of prices on expiration day. Okay, that's important, on expiration day. The purple line shows you what your P&L would be today. Now, the purple line is never perfect. It's never exact because different Greeks can change as price moves and market conditions change. So these are approximate P&Ls you could be across a range of values. It should not be held as gospel. Now, my friend is long the 80 calls right here, and he's short the 100 calls. So the most that spread could be worth is 20 bucks. Okay, I don't know what he paid for it, but let's just argue, let's for argument's sake say he paid $6. That's the price I've got inputted here at the bottom of my screen. Let's say he paid $6 for this spread, which is probably a fair price that he paid. I don't know when he got in, but let's say he paid $6. And then it goes his way. It rips his way. Okay. Well, both calls are in the money. The long 80 strike call and the short 100 strike call. They're both in the money. But he's wondering, Why isn't this thing closer to full value? The most it could be worth is 20 bucks. Why can't I get like, I don't know, why can't I sell it for 15 or 16 bucks right now? Well, check this out. If I unlock this price here, it's going to show you what the price is trading at right now. It's trading at approximately $9.48 or 58 cents. If I were to sell this spread right now, I would get 9.50-ish for it. Certainly not 20, not even close to 20. Why not? Well, it has everything to do with time value. Okay. We have until June expiration for these options to expire worthless. I mean, if you're looking at this silver chart right here, June is an eternity. Anything can happen between now and June. June is 6 months from now, right? This thing could go to 1,000. This stock could completely crash and come back to 50. Anything is on the table in a stock that's or in an ETF that's doing a parabolic move like silver is. So knowing that, options markets and options players and market makers are not stupid, right? There is premium in these options because of the wide variability of where this instrument can go. All right. And so when you look at the options chain, let me open up the options chain here, the June options. You'll notice that the at the money 105, let's call them the 105 calls, the at the money calls, actually they're slightly out of the money. They have a premium of 20 bucks per contract. That is enormous premium. No surprise, right? This thing's been going parabolic. People are going crazy. $20 premium. Well, here's a little hack. I don't know if you guys know this, but let me open up the strikes here. Let's go to like 50 strikes wide. I want you to pay attention to something. A good way to figure out what a premium is in a call without having to do a whole lot of complicated math, or like an in the money call without having to do a whole lot of complicated math, is let's look at this, like say 75 strike. Well, let's look at the 80 because we're talking about the 80, right? These 80 calls are trading at 31 bucks. Well, good back of the envelope, good hack, the quick hack to figure out how much premiums in them is just look at the corresponding put at the other side of the chain, right? Look at the 80 put. The 80 puts are trading at 705, 715. Those are out of the money, right? That's premium, right? So you can bet that the 80 calls will have about $7 in premium. Now you can go and do the hard math if you want. The stock's at 103, subtract 103, or you add, you add like 31. That's the premium here. 31 to 80. That's 111. You minus the 103. That gets you to 108, right? That's pretty close. Pretty close. So it's a good, when you got to do it quick and when you got to figure out what the premium is, you do it quick. Now, I'm bringing that up because the 80 puts, they have $7 in premium, right? But the $100 puts that are slightly out of the money right now have $17 of premium because that's out of the money. So that's all premium. Now, if I go deep in the money puts, if I go up here, if I go up to say the 150 puts, oops, and I look at the corresponding call on the other side, you'll see that there's premium of $10. So $10 out of the money up here, $8 out of the money here, premium, but $20 at the money. What I'm trying to highlight for you guys is that premium looks like a bell curve across a range of prices, okay? The options that'll have the highest premium are the ones that are at or close to the money, okay? Those will always have the most premium. The options that will have the least premium are the ones that are further away from at the money, okay? On both sides, further away on the downside, further away on the upside. It looks like a bell curve, options premiums, right? Options premiums are highest at the money, and then they come down as you go further away, okay? That's what a bell curve is. And so why that's important is because if I'm long the 80 call in June, that's great. It's working. I like that. Well, the 100 strike call that I'm short still has approximately $17 in premium in there. I need that premium to decay away for me to get anywhere near the full value of that spread, right? Because at expiration, if SLV, let's say it's at 120 on expiration day, right? What's going to happen is that 80, let's say it's at 120. The 80 call will be worth 40 bucks. No premium, all intrinsic value. It'll be worth $40 even, right? Well, the 100 strike call will be $20 in the money, no premium. And so the net, when you close both, you'll get 20 bucks, okay? I hope I said that right. I got confused there. I got distracted. But the point is that you need that premium in those short calls, especially the short calls, because they have the most premium right now. You need those short calls premium to decay away. Now, You have until June. That's the problem here. This is why this spread has so much further to go, because let me change our value here to the theoretical value that we paid to enter this trade, $6. We have until June. So your hope, if you're in this spread now, that if you want to get anywhere close to full value or even 80% of full value, which is what I like to do, I like to get 80%, which in this case I would sell the spread for $16. For me to get anywhere near that, I have to hope that silver kind of hangs above 100 between now and June expiration. That's a tall ask. That's a very tall ask considering how volatile this thing is. So you're faced with two options here, two courses of action, right? You can hold. It's not going to be an easy hold, but you can hold and hold out for more. You've got theta working in your direction now. Okay. You're not getting a lot of theta right now. You're not getting a whole lot of decay from day to day because you still have till June. The theta decay, it won't start accelerating until we get into early May is probably when you'll start seeing theta really work in your favor. So you have to hope that this thing either holds 100 or just screams higher. Like if silver finally gets like 150 or even 200, which is completely possible in a parabolic situation, then you might get your full value. So you need a big move continued in your direction, or you just needed to hang here and you got to sit tight. That doesn't make me feel comfortable. I don't like that. Your other option is just to take the profit. Okay. It's not the profit you hoped for, but relative to the heat you took in this trade, it's probably pretty damn good. At worst, maybe you were only down $100 in this trade. If you did a one lot, I don't know how big the size was. If you only did a one lot, let's say, maybe you were only down like $100 in the trade, but now you're up 300. So you're making $400 on a trade that you only took about $100 a heat. That's a good risk reward. Okay. So if it were me, if I were in this trade, I would take the profit. I would get out right now. Take it for what, maybe I'm disappointed with the profit, but a profit is a profit and I'm not disappointed about it. Okay. Another lesson here too is you got to match your time frame with your options trade. Okay. I don't know why my friend in the community got long this trade. I don't know exactly what he was hoping for. I don't know if he was playing for a quick pop or if he was playing for a long trend. But I could tell you, if you're playing for a quick pop, particularly if you're using options, then you want to have a structure that matches with your time frame. If you think the thing's gonna rip a few bucks, like maybe coming out of earnings or coming up in the next week or so because there's a breakout situation happening, then you probably want to do a shorter term options trade, right? If you think it's going to take 2-3 weeks for the play to mature, then you might only want to do an option trade that expires in 2 to 3 or 4 weeks. Okay. Conversely, if you're looking at a trend, if you're looking at a chart and you're like, man, this thing could run, $100 over the next 6 months. Great. There's an option trade for that, but that's when you use longer dated options so that you give yourself time for that trend to mature. So that's the thing that's a little bit different or very different with options trading versus say trading futures or trading stocks, is that you have to worry about timing. Like with stocks or futures, it's a binary thing. You buy the thing and it either goes up or it goes down, and that's how you make money. Well, with options, it's multidimensional, right? There are various Greeks that come into play that determine your profitability, an important one being time. Okay. If you're doing a spread, you might need more time for the trade to play out. Okay. Or if you're short options, right? You want those options to be short dated because you want to be in the part of the curve where the theta decay is happening quickest, right? You don't want to be short options that have, I don't know, 12 months to expiration. You're not going to get a whole lot of theta decay in those options in the short term. So just food to think about, food for thought. Hi, Dan, I see you in there. Hey, Harminder. I don't see any questions coming in. So interesting. Well, that's the lesson I had today for vertical spreads. Well, it's a spread. It's a lesson for a lot of things, but in particular, vertical spread. If you're riding this silver trade, my heart's out to you. If it were me, and I'm not your financial advisor, so take it with a grain of salt. But if it were me and I was in this trade, I would get out now. Take the profit. It's a nice profit. It's a good profit. You didn't take a whole lot of heat in this trade, most likely. So take it. There you go. All right. While I wait for any questions, if anybody has any questions, please chime in. But let's just point out here. Let's take a little spin around the markets. The S&P down a little today. No big deal. I mean, we're kind of in a holding pattern until the Fed at 2 o'clock Eastern. So I don't imagine the market to move a whole lot from here until there. We've had a pretty good run off that test of the 50-day moving average that we had. Was that early last week, late last week? No, early last week or late the previous week. Um, we're back at all-time highs. I mean, this we intraday today we did make a new all-time high in the SPY. Let's pull up the Qs to see what they look like. Well, Qs finally making noise here, like they want to get back to their all-time highs. It's been a while, right? They've been noticeably lagging. IWM, what are you doing? IWM's pulled back a bit here over the last 4 days, which is interesting considering SPY is doing so well. Something to keep an eye on. VIX, quick VIX check here. VIX rising a little bit. No surprise again. Fed today. People hedging or being speculative ahead of what could be a potentially big move. So VIX rising, not certainly at not any alarming levels with a 17 handle, but something to pay attention to. Christian is asking about the put ratio spread I did on SLV. Can you talk a little bit about how you structure that trade in terms of strike selection? Well, first off, Christian, I'm not in that trade anymore. We got out for a profit. We were dead wrong. I've talked about this a bit. In fact, let me bring up a different chart here. This will show it a little better here. Let me bring up my tasty or my what do you call this? Trend spider chart. So this trade I put on back on June 12th. We did a put ratio spread. I was bearish. Okay. I was betting that silver was overextended here. It looks laughable now, right? But I was making a bet that we were overextended and due for a pullback. So I put a bear put ratio spread on where I was short the February 75 calls, and I used those proceeds to purchase 266 put. What did I say? 75 calls? Sorry. I sold 175 put and I purchased 266 puts, and I got a net credit for the trade, right? The credit I received for those 75 puts paid for the 66 puts, and I got a net credit of $1.50. Now he's asking, how did I select those strikes? Now look, there's no magic on that, Christian. At the time when I put this trade on, silver was trading around 78 bucks. Okay. 75, I believe, was the next strike below. So it was basically the at the money strike. It might have, I don't know if there was priced in dollar increments, but 75, nice big round number. It was basically the at the money strike. Okay. So I wanted to sell that. Why? Remember we were talking earlier about premiums in the bell curve, right? The highest premium you can collect is the at the money strike or near the money strike, right? So I wanted to sell that put and get the most premium. Okay. So I sold that put. Now, why did I select the 66 put? Well, the real magic to that, Christian, is that I didn't want to risk more than 800 bucks on this trade. Okay. And so doing the math, if silver traded down to 66 and just sat there, okay, I'm on the hook to cover a short put spread, right? I'm short the 75 puts, long the 66. The most that spread could be worth is $9. Okay, I would have to buy that. I would have to pay $9 to cover that spread. Now I collected $1.50 on the way in, so my net loss would be $7.50. All right, I was willing to risk as much as $8. Really, that's it. That's the reason, Christian. There was no magic at those strikes. I didn't think that those levels, any one of those levels, were any magical level. I just wanted to tailor my risk to what was appropriate for my portfolio at the time, and I only wanted to risk 800 bucks. So that's the great thing about options, guys, is if you're an options trader and you're using option strategies, if even if you're just doing a simple call or just a simple long put, whatever you're doing, if you're doing defined risk spreads, we'll leave the undefined risk spreads out of this conversation for now, or undefined risk trades. But with the defined risk, this was a defined risk trade, you can define your risk up front. You could tailor your trade to risk as much as you're willing to risk, exactly to the penny if you want. All right. And I did that here in silver. So that's why I selected those strikes, Christian. I hope that makes sense to you. I don't know if that's the answer you were looking for, but it looks like it was. Okay, great. Richard asks, is there a particular amount of time or weeks or months that are used for an average to do spreads? No, it was not. It really matches up to it with How much exposure do you want? For how long and why? Right? For example, if I'm looking at silver right now, and let's just keep it simple. I wouldn't buy puts here. The premiums are too high, right? But let's just, since we're here, let's just pretend I'm going to buy puts in silver, right? Now, if I'm buying puts in silver, I'm looking at this chart and I'm thinking to myself, I'm either going to be wrong in a hurry or this thing's about to turn any minute now. Thinking that, I'm thinking shorter time frame. I'm thinking I want to buy puts that expire, maybe in the next couple weeks, right? Maybe in a month tops, right? I think this thing could roll over within the month. That's my thinking. I don't want to buy puts that expire in January because this thing might fall off, but my profit might not be as impressive as I think, because conversely with silver, if silver rolls over, this is unusual, but if silver rolls over, a lot of premium is going to come out of options, because right now people are scared about the upside in silver, right? Options participants are scared about the upside. So if we roll over, and even if we just kind of roll over and sit, the premium in these options is going to come way down. The premium is very overextended right now. So if I were to buy a put with January expiration to play a pullback, yeah, I might get the direction right, and I might make a little bit of money, but I'm going to make far less than I would have thought, because of so much time to expiration, and a lot of premium is going to come out of those further dated options. Okay. So if I'm betting a reversal here, I'm going to go shorter dated. Now, if I'm looking at a stock that's making a fresh all-time high, a new all-time high, I can't think of any off the top of my head. I mean, there's a million of them, but something fresh that like just happened. Well, this is not a new all-time high, but here's a stock I got into yesterday, Pfizer. This stock hasn't really broken out yet. It kind of faked me out yesterday, unfortunately for me. But a chart like this, I could look at this and say, yeah, it's still got a little work to do. I think this thing could break out soon. But if this thing has a big move, it's probably going to take 6 to 12 months to play out. In that case, I want to go further dated. I want to buy options that have 6 months expiration, 9 months, 12, maybe longer. Especially if volatility is low. If volatility is very low, that means options at premiums are affordable and cheaper than usual. So that gives me the ability to get better leverage on a longer dated call. As far as choosing your time, your expiration, at least for me, I know there's other people that do it other ways, but for me, it just really has to match up with how long do I think I need for this trade to play out. And by the way, it's a guess. I don't care what anybody tells you. Nobody can predict the market. Nobody can predict the time frame in which things happen. A lot of people will tell you they can. A lot of people will hint that they can, but they're all lying to you. Nobody knows. All we can do is put our best foot forward, take our swings, manage our risks, put ourselves in position to get lucky, and use our heads. We're smarter than you think. You are smarter than you think. I promise you. And when you look at a chart, you could probably make a reasonable guess of how long a move might take. That's how you choose your expirations. It's no magic, guys. That's the thing about options trading. There's a lot of people out there trying to sell you gimmicks on options. They've found some secret sauce, some magic strategy that works all the time, makes money all the time. It's bullshit. All of it's bullshit. All right. Don't fall for snake oil salesmen. Options trading, successful options trading, successful any trading, not just options trading, whatever product you trade. Successful trading comes down to smart risk management, smart position sizing, and having a plan, trusting your plan and following your plan. That's it. That's this. If there's anything close to a secret sauce in trading, that's it. All right. There you go, folks. That's all I got for you. We're almost to the bottom of the hour. I don't see any other questions here. So, ladies and gentlemen, it's a Fed day. Go take a walk. I'm going to go take my dog for a walk right now. I'm not going to do anything. I'm not going to press any keys. I'm not going to get in any trades here. It's kind of pointless. So perhaps you will do the same. Good luck to you the rest of the day. I'll be back tomorrow at 3 o'clock Eastern. All-Star Options Jam session. Tune in. Got some portfolio updates to talk about that some of you might find pretty interesting. I think you'll like it. All right, so tune in tomorrow at 3 o'clock for the All-Star Options Jam session. I'll see you then. Until then, take care. Be well. See ya.